Hey guys, we're going to look at the S&P 500 here, give you an update as we are moving into earnings season. And a lot of people have been asking us where we think if the S&P can continue to rally at this rate. And so let's have a quick look. Flipping right over the charts, the more you zoom out on the chart, the scarier it looks. So if you look at the S&P 500, just on the daily chart, what you can see is that we're up, I don't know, what are we up now? Something like... yeah, just north of 10-12% year to date. You look at that on a weekly chart, and you can see a bunch of weekly steep moves, and then ultimately you move out on over to the monthly chart, and you can see every month for the past number of months, except like one in the middle there, has been just a really strong move. So at some point the mean reversion move will take place. The question is when. So what we do know is heading into earnings season, there's always that risk that a couple of companies give us, some more cautionary outlooks. And of course, we have a lot of sort of influences right now between COVID and the reopening and all that kind of stuff happening. So our guess is it wouldn't take a whole lot for the S&P to mean revert. So to give you a very simple way of looking at this, but I think one that really helps from a risk management perspective. Actually, let me look at the VIX first so you guys can see this. Options are very cheap right now. That's kind of the main point I want to just bring across. So the VIX, as I'm recording this here, somewhere around 17, maybe it goes down to 15, I don't know. But the point is the VIX is the cheapest it's been in quite a long time. So if you wanted to buy some puts, buying some protective puts using early summer kind of at the money puts or put spreads, we think that makes sense from a tactical perspective. We think ultimately equities will hold up quite well through the next few months. But I think if you want to protect yourself going into earnings season, just buying some cheap puts here on the SPY ETF does make a lot of sense. If you need some numbers to get your head around, let me just quickly show you the S&P 500 itself. And what we're going to do is add two simple moving averages, the 8-day moving average, which is that little purple line that you can see here, and then the yellow one, which is the 21-day moving average. And currently, the S&P 500, as I'm recording this here on this day, which is the 13th of April, the S&P is trading about 3.3% above that 21-day moving average. If you compare that to, for example, where it was in February, it was just north of 2% above that 21-day moving average, and then it mean reverted. We're just looking at a very short period back. At some point it was north of 6% above the 21-day moving average. The difference, of course, is that we here have an upward sloping moving average, or being above it, all else being equal, is going to be above it higher than if you have a flat moving average, if that makes sense. Anyway, very simply, if you want to play this tactically, and if you don't want to just buy puts, what you can do is you can wait for the S&P to break below the 8-day moving average, which is that that little purple line. And if it breaks below there, there's a pretty good chance, I would say north of 70%, that it reverts back down to the 21-day moving average. So if you want to play this tactically, this is the way we would do it, to look at the moving average. If you just want to protect yourself a little bit heading into earnings, because again, as good as things look from a reopening perspective and all that kind of stuff, it doesn't take much in terms of cautionary wording on the part of some companies to see a mean reversion move of 5, 10, 15% in the S&P. So if you want to protect your portfolio that way, again, we would say buy some early summer, June, maybe July, at the money puts in the SPY ETF. Again, keep it really simple, hold it on for a few weeks. There's really no reason to make this overly complicated. But if you're long a portfolio of stocks and you want to protect yourself, or if you want to just do a speculative trade, you can buy the puts. And if you play tactically from a trading perspective without options, then maybe just wait for the S&P to break below the 8-day moving average for a move back down to the 21 days. So I hope this makes sense. If you have any questions or comments, let us know, and we'll see you soon.